Good morning, everybody, and welcome to the last of the IMAP Specialist Webinar Series for 2022. We've got a fascinating series this week. We're going to be looking at the issues around boutique investment managers. In a world in which the big appear to be getting bigger, what are the advantages that being a boutique, being a specialist brings to the investment management? We're going to have a particular approach to this with regard to managed accounts. We've broken this week's series into three. Today, we're going to be talking about Australian equities. On Wednesday, we're going to be talking about international equities. And on Friday, we have a number of portfolio managers talking about alternatives, challenges of being a portfolio manager, and incidentally, the issue around alternatives. So before I hand over to Nigel Douglas, who's generously agreed to be today the moderator for this week's series, let me talk a little about 2023. It's coming up very quickly for all of us. And let me take you very briefly through the events that we have planned for 2023. In February, our virtual technology conference, Investec. The theme for Investec in February will be technology and its role in the 20-year advice relationship. As you all know, advice relationships don't start and stop at the SOA. And to my mind, the critical issue around advice is not, can I save $1,000 in creating an SOA? It's what part does technology play in creating, facilitating, enhancing the relationship that I expect to have with a client over a 20-year relationship. In March, our portfolio management conference in Melbourne, Sydney, and Brisbane will give us an opportunity to showcase the thinking of investment managers. In April, the Managed Account Awards start, and this year, in response to a number of requests, we'll be including a category for smaller licensees, the boutique licensees. Nigel, the moderator of this week's series, it has been one of our judges since inception. Then in July, Advice in Action, which, as those of you who have attended will know, focuses much more on practice management issues, the commerce of managed accounts, some of the issues around running a successful advice business, successful advice practice. And then finally in September, Independent Thought, which we commenced this year, which is an opportunity to showcase the thinking of a number of this week's participants, the portfolio managers who are increasingly the focus of the development of managed accounts. So before I hand over to Nigel, just a quick reminder that we encourage your questions. We welcome an opportunity for you to submit those, and this is the mechanism, as I'm sure you're all aware. So Nigel, thanks very much for your time, and I'll hand over to you to introduce today's panelists.
Thanks, Toby. I'd like to introduce our three panelists. Callum Burns, Managing Director and Lead Portfolio Manager from ICE Investors. Lidbury, Head of Investment Research, Perpetual Private. And Marcus Bogdan, Chief Investment Officer, Blackmore Capital. Now I'll start with the first question for Kyle. What is the business opportunity in running an Australian equities managed account?
Thanks very much, Nigel. And yeah, it's great to be here to talk about Perpetual Private's, in effect, our internal boutique in terms of direct equities managed accounts for our dealership. To talk about the advantage, I guess it's good to give a bit of history in that we, as a practice, had a lot of clients using direct equities, but it was in an advisory fashion and not necessarily as aligned to portfolios. And so in 2009, we established an internal direct equities team designed to align and manage direct equities portfolios on behalf of the business. If you fast forward to today, we're an $18 billion dealership with about $5 billion in direct equities. So it is, a somewhat substantial practice. But the main reasons for doing so are still the same. The number one reason is around consistency, and consistency in terms of portfolio experience and client experience across the firm. Having our own team, obviously we're part of a firm that has a very well regarded and established Australian equities capability in the funds management division, but we were very conscious of designing a service that was appropriate and built for purpose. So we wanted a team that was going to run effectively a managed account, be used to that transparency, be able to deal to that environment transparency. And often a lot of fund managers may not have that culture within themselves, as well as be representative to clients. And that was a really key thing for our advisors to get on board, was to have access to the portfolio managers and analysts that were making the calls in that portfolio, and being able to talk to clients with a lot of transparency, because as we know, managed accounts are a full transparent solution. And then also, to have, I guess, in terms of capacity and understand that these portfolios could run independently. And so it is a team that's Chinese walled off from the managed funds business. And we wanted to be in control of our capacity in terms of the market and be able to control that, because just like with funds, managed accounts aren't exempt from that. In fact, they actually have some disadvantages around execution that you need to be highly aware of. And so again, just that importance of having a team that's aware of the investment solution they're running and be able to manage it appropriately in that regard.
Thanks, Carl. And Callum, as an established fund manager, why did ICE investors move into managed account space?
It was primarily driven by client demand, Nigel. So just to sort of recap, so we started running the ICE fund in 2006, and it was set up as a managed fund, and we ran that for many years. And what appeared to happen is a number of clients chose to use the managed fund inside their managed account structure. So of course, the way it would work is they'd have their 40 or so large caps that Kyle's referring to, and then their small caps would be one line item being the ICE fund. And that suited many, but there was some that wanted that extension through into the small caps as well. So we supported that and put that in place. We've probably had in place, I'm trying to remember the exact time, but probably maybe 8 years or something of that order. And it was a really interesting exercise. Again, picking up what Kyle was saying about the execution, because the execution can be a bit different, where in most instances the actual platform does the dealing rather than you do the dealing yourself. And with large caps, I think less difference. But I think when you're getting into small caps, sourcing liquidity from different points, that we found created a little bit of difference. So, we sort of honed and refined the process over time, so that what we now do is our managed account solution is a little bit different to our managed fund structure. And the reason we do that is it's got a liquidity screen to it. So that really makes it more efficient when we've got the platform provider doing the dealing rather than ourselves. And that's something that we found to be over time very important, and it's quite a significant learning. So that's really been our journey with respect to IMAs.
And just Callum, do you have your full investment team and lead portfolio managers working on the managed account?
Yes, we do. We have one of our, again, because there is a slight difference. What we do is we have a team-based approach. I'm one of 3 portfolio managers, and there is we have our analyst as well. And, we're focused on the ICE fund. And then one of the PMs is just focused on the tailoring that's required for the managed account. So it's not really sort of a massive exercise, but some of the smaller companies, the very smaller ones are not in. And as a result, you might need to bring in 1 or 2 other names. And so that particular PM takes responsibility for that, under my oversight, of course.
Great. Okay. Now, Marcus, Blackmore's taken a different path to the other 2 panelists.
Yes. So very early on, when we established the portfolios in 2014, we realised that investors and advisors wanted to have access to an expert in a particular asset class, and our area of expertise was in Australian blue chip equities. They wanted to have access to that knowledge and that expertise, and they wanted to be engaged in the process. And the managed accounts and the SMA structure allows them to be able to do that, both at an investor level and an advisor level, primarily because they've got complete transparency over viewing their portfolio, and many of those names that they recognise, they're household names, and it provides engagement and interest from an investor's perspective and from an advisor's perspective. And so that was the sort of the key business proposition of us setting up managed accounts. And at that stage, there was technology available to do that. So we were meeting, I think, a growing need for access to expert fund managers, but in a format which was very similar to what they'd seen in direct equities.
Actually, as a new entrant, there's over 100 Australian equities managers of various types. How profitable is it in your experience?
Well, I think with anything, you need to be able to build scale, and you need to illustrate, a strong track record of managing equities and portfolios through the different investment cycles. We're focused, and we'll come to this later on quality and a blue chip portfolio, and there's always a need for that in any advisory or wealth management firm.
Okay, I'm glad you mentioned quality because we hear that a lot. Callum, how do you identify quality stocks, and maybe provide some examples of them? And a question that is often asked is, are there really enough quality stocks in the Australian equities market to build a reasonable managed account portfolio?
Yeah, just picking up your early comment, the word quality you do hear a lot, and there's it's a broad church with many definitions. Our definition of quality is we look to invest in business franchises. So when I say franchise, I don't mean Kentucky Fried Chicken. I mean necessarily, I should say. I mean, business which has an economic moat around it that makes it hard for competitors to come in and take the company's revenues. So in order to do that, our definition of quality is we look for companies that got assets that are difficult to replicate, and are managed so that the customers are sticky. So that's our definition of quality. And in short order, the answer is yes. There are many. We're talking hundreds of companies on the ASX that met that criteria. But interesting enough, many of them outside the top 100. And it's something that's not often understood. And I think the word quality and size gets /well-known. They get mixed. And just because something's large today and well known, that doesn't necessarily mean the way we look at quality, a quality company, because it might be a price taker or just selling a commodity or something of that nature. So no, the answer is there's many of them, but the answer is far more outside the top 100 than are within it, and that's something not particularly well understood, I don't believe.
We've lost a video, Callum. And what are some examples of those quality stocks?
Sorry, Nigel, have I just come back on then?
Yeah, you've come back on.
Yeah, another one of the joys of Zoom that COVID has dealt us. So apologies for that. So look, there are many, and so some examples. I've just picked these on purpose because all these companies have a market cap greater than $1 billion, and yet a lot of people haven't heard of them. So one, for example, is APM. It's Australia's largest service provider to the government in running return to work programs. And they've got the #1 market share, they've got the highest rating, and there are certain ways in which that business gets rated by the government that makes their position very, very entrenched. They've also got operations in the US, UK, and also Sweden. So it's a very large, very well company, founder run, same person as chair now that built the company from scratch many years ago, global, and yet many people haven't heard of it. That's one example. Another one's called PSC Insurance. It's a insurance broking firm here in Australia. So it's a group that set up OAMPS, an insurance broking chain later bought by Wesfarmers, you would have heard of. And then many years later, the band got back together and they've built PSC. So they're, substantial, very well run, substantial operation here in Australia, and have got substantial operations in the UK. For example, they own a business. One of their businesses is very strong in cyber insurance, which is, of course, a very strongly growing area. That's an example. And EBOS, which is Australia's largest pharmaceutical distributor. And that one was interesting because when we first got invested, it was a $1 billion plus company. No one had heard of it because it was listed in Australia and New Zealand, and yet most of the shareholders, Equities was in New Zealand, and yet many of the shareholders were in Australia. So there was a little sort of anomaly there that made that an attractive proposition. But just briefly, there's 3 examples, but I won't talk any further. I get excited talking about stocks, as you know, so I better stop there.
Well, that's what stock investing is all about, of course. Marcus, your definition of quality and a few stock examples.
Sure, I agree. The overlay that Callum gave in terms of looking at strong franchise businesses that have been able to operate and succeed through a range of different economic environments. But then we also include some sort of tight metrics of what we define as quality, and we measure them at a portfolio level. And so there's types of metrics that are important to us. Return on capital employed, or ROE for financial companies. Higher than average operating margin, strong cash flow conversion, and then things like net debt to EBITDA. Having a strong balance sheet is absolutely critical. And then we look at a factor called equitization in terms of, is the company raising capital, or are they buying back capital, or actively involved in capital management? And we overlay that across the entire portfolio. And what we've found that consistently is that our portfolio, which we would deem as quality at a reasonable price, those factors actually screen higher than the average of the ASX 200 benchmark. Some examples of that would be companies like CSL, strong growth company through the investment cycle, very good return on capital, and a pristine balance sheet. Goodman Group, the logistics warehouse group, again, probably the strongest balance sheet out of the property in the REIT sector, and has been able to deploy that capital at high rates of return.
Okay, good. Kyle, what's the Perpetual perspective?
Yeah, and when we set up the team, it was really important that we sort of had an alignment from a brand perspective. And so we view quality in a similar way to our broader business. We are looking at the quality of the business, the economic moats, or the resilience of that business model, and its ability to execute, in terms of what it wants to do with high barriers to entry, etc. But we're also looking at debt levels on the balance sheet. We're ensuring that companies are, appropriately leveraged and not over leveraged, and operating within their limits. Definitely in terms of taking a view on management and management teams and their experience and their track record of success. And then, importantly, just the recurring, are they profitable, and do they continue to be profitable over time? And that's also reflective of, those sort of resilient business models. So, that's definitely in terms of how we're looking at quality. But then, just like, Marcus, we are then taking a look on the valuation of the business, and is this an appropriate price to be buying that business and buying that investment, because valuation is a driver of returns. And so you can't just look at the quality of a stock without having sort of attention to that. The way that we construct portfolios is designed to be an Aussie equities exposure. And I think it's really important to understand how you're using the managed account within the context of your broader portfolio and what you're trying to do. By far and away, our most used portfolio is our ASX 100. And so we have built that portfolio to take on, I guess, the majority of that sort of larger cap end of the stock universe. Obviously, from a managed account perspective, we have a cost advantage there versus managed funds and other vehicles that we're investing in, because you don't have that sort of infrastructure to maintain around it. But then we also complement that portfolio with appropriate small cap funds or unconstrained managers, and knowing how you're using the managed account, I think, is really important, because then you know what the portfolio is supposed to do and why you're using it in that broader multi-asset context. If you're operating a managed account with a very high tracking error, that's not great from an asset allocation perspective, because you're allocating to that asset class in order to gain exposure to Australian equities. You want your Australian equities to act like Australian equities, So when we look at our ASX 100 portfolio, yes, we've got exposure to the big four banks in there. We have exposure to CSL and large companies in order to ensure that our tracking error remains within the realms of what our clients would expect from the portfolio. And we're also reporting on the portfolio at that level. But then, we want that high focus on quality, because you need to have stocks that aren't going to go, have a high probability of going to zero or sustaining significant losses. That's just you're going to have full transparency around that with your clients, and so you want to ensure that quality is built into the portfolio as well.
So just what's the advantage in being an active manager as opposed to buying a quality ETF, for example?
In my view, yeah, absolutely. I mean, we as a house obviously favour active management, but we are taking more passive or more rules-based strategies in areas where we believe they're fully efficient. We take an active view in Aussie equities, but there's some of our portfolios that might take more of a passive view when it comes to, say, the top 20 stocks, for example. And that would be similar to sort of other efficient markets. So by having by having control of your managed account, we can actually design that to fit into, I guess, our broader investment philosophy and our broader multi-manager team. And that's one of the big advantages and big reasons why we've got our own managed accounts team, because we can ensure that that's aligning with how we're using the managed account. So I mean, from that perspective, and then also, our clients have a preference to owning shares directly. There's also other advantages around being able to, govern which stock parcels from a taxation perspective and a capital gains perspective. Having the securities in your portfolio and not investing in opaque structures is not as much of an issue here. But when, I always quote, for example, a fund in the UK that wasn't doing the right thing with a really great investor, a gentleman by the name of Nigel. What was happening in his fund wasn't apparent to his investors in terms of use of secondary exchanges and taking larger than exposures than he should have through different means. And I think that's one of the advantages of managed accounts. The securities are in your client's account. You can track those. You have full transparency around it. Similarly to ETFs, they're opaque vehicles as well. And so, you just need to take that into account. I think, large mainstream...
They're cheap though, Carl, they're cheap.
Yeah, and large mainstream managed ETFs aren't going to get you into trouble, right? I think it's more at that exotic end and more of those sort of interesting strategies that you want a bit more transparency and understanding of what you're investing in.
Okay, great. Okay, just moving on to our next question. Marcus, how do you customize your portfolios to meet particular demands of your clients? I mean, Kyle was alluding to some modifications.
So we run 3 strategies with the focus on the ASX 200. We have one portfolio where there is more emphasis on capital growth. We have another portfolio where the emphasis is on sustainable and growing dividend yields. And then we have a third portfolio, which is a concentrated portfolio of where clients and investors want a much smaller version of our larger portfolio of sort of best ideas. So it's very important that we know our universe, which is the ASX 200, Each of those portfolios has a similar investment objective, and that's primarily to grow capital and dividend through the investment cycle, but to do that with lower volatility and lower investment drawdown. So we have to be true to that in terms of our portfolios and how we customise those portfolios. And that provides us, the clients that we face into a sort of a broader selection, but with that emphasis still on quality.
Right. Callum, how do you see that? And this is a question also for everyone about transparency in a managed account. You know, the need to communicate and other demands that's placed on your time. So Callum, over to you.
Yeah, well, I guess the main thing is where we start from is we're trying to build the best possible portfolio of these business franchises, you know, the companies with assets that are difficult to replicate and sticky customers that we can. So that's our starting point, and we do that. And we put that portfolio together, and that's our best ideas. So of course, we don't want to give our clients our second best ideas, we want to give them our best ideas. So that's what we do. And we provide that for clients. Enmeshed in that, of course, is that, you know, we are doing the execution ourselves within small caps. You know, there are certain nuances with that. And then if clients, you know, don't want us to do the dealing, they want their platform to do the dealing, which is a highly appropriate choice. But when they want to do that, of course, they get the transparency, but we don't do the dealing. In that instance, we make appropriate adjustments to the model, just allowing for the liquidity. Because, you know, as an active manager, we do source liquidity in all sorts of different places. And we need to take into account of that when, you know, we're not doing that particular part of the function. So we make that adjustment, you know, and that's the way we do it, Nigel.
What about for clients with responsible investing or ESG concerns?
Well, that's not a big issue for us. The reason is that this started 17 years ago. What we're looking for are companies that have what's sitting behind what I've talked about, companies that have a, you know, sustainable or durable competitive advantage. That's what we're investing in. So for example, and the key word there is the durability of it. So say you go back 17 years ago, before the words ESG were even spoken, imagine there was a company that would, for the sake of argument, was making a lot of profit and was doing really well, but because it had, you know, say rapacious environmental practices, we would never invested in that company because we would always assess it as saying the government will eventually come in and not allow them to do it. So you find our portfolio, we don't really have we don't invest in resources. So it's really not a problem for us, the whole ESG thing, because of the way we manage money. And that's sort of always been the case.
Kyle?
Yeah, so we run ESG screens across all our securities, and it's exactly what Callum was saying, right? It's as part of, the G in ESG, the governance piece, is part of any risk assessment process. It's part of assessing the quality of a business. You need to ensure that everything's kosher. And I think more recently, the lens around are companies doing what they say they're going to do in terms of that greenwashing aspect is becoming increasingly important as well, right? But we also run an RI specialized portfolio for investors that are interested in that. And I think that's going through more of an evolution as well. I think historically we've screened out negative industries for that portfolio. We have charities and not-for-profits that for their stakeholders to be invested in, tobacco or gambling stocks. If you're an asthma charity foundation and you're investing in tobacco stocks, I think stakeholders would have a bit of an issue from that in terms of a reputational aspect. So that's been the focus. However, we are evolving more, and I think the question around resources is a good one. That acknowledgement that resources are going to play a key part of any energy transition, I think, has got us focused more in terms of finding opportunities in that space. Although historically our portfolio has screened out extricative industries, I think it is important to have an RI approach that's evolving and can evolve with this growing interest in the sector. And so I think RI investing's got enormous potential, and obviously I think believers in the sector from a a returns perspective are actually thinking that these portfolios will have a structural advantage in terms of outperformance, right? If there's so much capital and so much interest in that sector. But that will translate through to traditional portfolios as well. I think both Callum and Marcus, when they're looking at companies, if there's an opportunity in terms of that environmental sector in a business that's set up to take advantage of that, that's going to attract the interest of all investors, not just ESG or RI focused investors.
Okay, Marcus, what's your perspective on catering for the demands for RI investing?
Well, I mean, as Callum said, I mean, ESG has been part of the way that we've looked at companies right from the beginning. It's been elevated to a much higher level today. But we look at 6 different factors when we're screening companies, and one of those is ESG factors. Now, if we are focused on quality, whether it's quality earnings, quality balance sheet, or quality management, that also has to apply for ESG factors. And if they're leaders in their industry, well, they need to be leading on those key environmental and governance issues. And that's the sort of test that we put the companies that we have. We do find that the materiality index is particularly useful because what's material for one industry, such as the mining, is very different from a financial services company. For a resources company, well, then health and safety and the environment are absolutely critical and point to the quality of the underlying franchise. Whilst in a bank, things like data security and privacy are far more material in those types of businesses. And so they're the sorts of overlays that we place in determining our ESG factors.
Okay, great. Just turning back to the business side, what capacity limits are there for your strategies? And is Rapid's funds growth, is that a curse for boutiques? When do you stop becoming a boutique, when you get too big? We can start with Callum, since you've got an established funds business.
Yeah, well, it wasn't once, Nigel, so I can comment on this. Look, we have a capacity limit in small caps. It's just critical. If you get too big, you just can't. You can't do the job. So our capacity limit is 0.5% of the market capitalisation of the Small Ordinaries Index. In today's market cap dollars, it obviously moves as the market moves. That's roughly about $1 billion. We have been told from time to time that's a little bit small, but we'd rather have something smaller where we can definitely do the job for clients than have something bigger and sort of push that limit. So that is absolutely critical, and we have that in place, as all reputable managers do. Is rapid funds under management growth a curse of boutiques? I would say no, but how you manage it can be. So just to explain, if you have a strategy that is set up to scale, and from day one you're explaining to all parties that I might be managing X, but if we were managing 10 by X, we can demonstrate to you that with liquidity, etc., we could manage the same money in the same way. It is not a problem for you. However, you do need to manage very carefully the business demands that come on with that process, because when you're running through the rapid inflow stage, you're getting asked for pictures, you're getting asked for updates, etc. And you need to manage that very, very carefully so that the investment professionals are not distracted from what got them, them and the clients there in the first place, which is managing money and delivering a good result. So that distraction must be managed so it's not a distraction. So the way we do that in our shop is that no matter what happens, 80% of everyone's time must be at a bare minimum be on in the investment management. So I'm including during other periods. So the distraction factor is managed to a very low level. And when I stress minimum of 80%. So every single individual. So that's how we manage it. But in itself, it's just critical. And I think that's something that people underestimate. They suddenly hit a growth curve and the demands start rising on them. And, it's easy to take one's eyes off the prize. So that would be my comment on that.
might be good to give everyone an idea of how large, what's your FUM and number of people in the company.
Yes, so we manage $600 million. So the investment team at the current time, so the investment team, there are 4 of us, three PMs and an analyst. So analysts have got 12 years experience, and our PMs have all got minimum 20. So it's obviously a well-seasoned and very well-credentialed team. We also have an alliance with SG Hiscock. So through that, we have access to a middle office team, which has 2 people. We have a distribution team, which is 5 people, and an ESG team of 1 person. So that's the full resources that we bring to bear on managing money.
Okay. And Carl, Perpetual Private's part of Perpetual. As we know, Perpetual's a very large Australian fund manager. So, how's the resourcing and growth aspect work for Perpetual Private's Australian managed account portfolios?
Yeah, and so I mentioned up front, our team is quite separate to the funds management business. And so we have a team of 5 that sits within Perpetual Private, and it runs 3 portfolios. And so an ASX 100, a broad cap ASX 300, and a responsible investment portfolio. I think importantly, it's just, you need to understand the level of resourcing, what the portfolio is doing, how you're using it, right? And I think, there are questions about, do these teams have disadvantages versus, much larger resource teams with more analysts, etc. I think it does come back to that. You need to actually understand the strategy that's being run. Our team is also set up to talk to clients. And so whilst we don't have sort of hard 80-20, I guess, rules in terms of investment versus client time, I mean, the majority of analysts' time is definitely on stocks and their portfolios. However, and again, talking about why we're offering managed accounts to clients and what our clients value, they value being able to have access to the portfolio managers. They value having access to the analysts, and, given the size of the team and our business, we can provide that value by resourcing up the team to do so. So I think that's one of the really important things about managed accounts, is that what's the value proposition that you're giving to clients with it, and that's a key part of our value proposition, is that our larger clients and our clients across the board, to be honest, will have access to those portfolio managers and be able to actually talk to them about portfolios. It is, as I said, Chinese walled off from the funds management business, but that's part of the whole reason we have it in the business, and one of the things that our clients really love about investing in our direct equity portfolios.
Right, okay. And Marcus, your resourcing?
So we have 4 people on the research side of things. 2 of them are PMs. Both of us have got 30 years experience in the Australian equity market. Our universe is defined by the ASX 200, and our quality screens will then screen those 200 to a universe of around 50 stocks. And then where we require additional services, because we're generalist investors, and I think that has some advantages in terms of we don't fall in love with any of the companies or the industries that we operate in. But when we need additional expertise in certain sectors and industries, through our contacts, we can source, world industry leaders in terms of that. And then additionally, we've been able to automate a great deal of the data that we use. And so at the beginning of the process, we would take several days to process a range of data. Now we've got that fully automated. We can just use a screening platform to be able to do that. But we find that smaller teams rather than larger teams are advantage in terms of the ownership of the decisions that are made is particularly important.
Just might be worth mentioning turnover, because when people estimate capacity they have to take that into account, and turnover is particularly important in managed account space when you're executing through a platform. So what's the turnover of your flagship portfolio typically run at?
20 to 25%, and it's important to break that down. So, the criteria to put a company in is it's a high barrier, and then we have very clear lines of distinctions of when we sell a company, primarily around deterioration of quality of earnings, balance sheet, or ESG factors, or excessive valuation. And we want to compound our returns, and we're very focused on after-tax returns that we give investors, and hence our turnover is at the lower end of the spectrum.
Callum, what's your turnover run at typically?
Yeah, we're about 30 to 50%, depending on the year. Sometimes it's higher, it's not often lower than 30%. If you sort of ask me you probably gathered from what I was saying before that we have a very long-term orientation to what we do. We actually invest on a sort of 7-year internal rate of return. If you ask me what's one of the biggest surprises I had since setting up the fund 16 years ago, I thought our turnover would have been a bit lower, but what you find in small caps is when the stock market gets onto a good company that's been undiscovered, they often tend to get excited, and then the valuation will rush past, great company, but rush past, more than what you assess. So that creates some turnover itself, taking the profit and then reinvesting obviously in the new ideas. But sort of 30 to 50% is our number, although there have been rare it's over that, but in the GFC and also in COVID, it was about 85% or so in each of those years. Obviously, there's a lot of volatility, a lot of opportunities to pick off, but that's our turnover picture.
Yeah, there's plenty happening. And Kyle, how's the large cap portfolio done in terms of turnover?
Well, we target no more than 30% a year, again, acknowledging that it's a managed account, we manage the portfolio as such, right? So we don't, for example, trim positions or trade positions around the edges. We are generally trading when we're adding a stock to the portfolio or taking a stock out. It's a fully invested portfolio. We're not running a cash balance or anything as part of the managed account. And so, we expect it to be 100% invested all the time. And so we find it's pretty easy to stay under that 30% limit when you're not, trading the book per se. You've got to acknowledge that one of the big disadvantages with the managed account structure is the lack of control that you have as a portfolio management team around execution. Most platforms will centralize that. And the key benefit of that is a huge, it's a decent cost advantage in terms of retail brokerage. So managed account platforms deliver a much lower cost of brokerage compared to, traditional, broking. And so how is that cheaper? It's cheaper because they're not necessarily guiding things through the market or having a conscious trader around that if you're trading a difficult position. And so in order to keep the portfolio aligned in terms of what you're trading and the performance that you're sort of publishing, I think it's really important that you look at the trading of the portfolio and understand what that impact is versus, in terms of client experience and the client experience returns versus the model returns. And so we're just really conscious of all those things. As I said, this is all this team does is run managed accounts. So they're not running a managed fund and they're not trading it like a managed fund either.
Okay. And just as a business becomes more successful, what is the temptation to have a proliferation of products and, marketing them extensively? Callum?
Yeah, well, I'll just answer this from our own perspective. There's no temptation. We exist to be, got a certain thing that, we are perceived as being good at. And our goal is to be as excellent in that area of activity as we can be. So you can't be from our perspective, you can't be great at everything. You should focus your resources on what you're good at. So no, we don't have any temptation for strategy proliferation. Could that mean at some point we do an extension strategy, which is if you effect us, an extension of what we're currently doing? That's something we could consider. But in terms of having a whole range of things in all sorts of different arenas, no, we wouldn't see that as being a move that would be in the best interest of clients.
Right, and Marcus, you've got two managed account strategies at the moment, right?
Yeah, and 3. We run a concentrated
3.
portfolio as well. Yeah.
Oh, okay.
Yeah.
3. So any plans there to bring in new ones?
No, not at this stage. And I think, like Callum, we potentially extend the same philosophy and methodology, but focus is absolutely critical in managing capital. And we look at focus in the companies that we invest in directly, and if they're proliferating their strategies or they're growing too quickly, it's a red flag. And it's the same with us. We want to be have a high level of competency in our subject matter and our focus, and so that the temptation there is virtually zero.
Right. There's actually a question from the audience. It's relevant. Is it difficult for a boutique to compete with large managed funds with significant resources and large teams of analysts? So Marcus, I'll let you answer that one as well.
Yeah, I mean, and both of the PMs in our group have come from large organisations previously and larger teams. And I go back to my earlier point. It's the ownership around each decision. We are well covered with a PM and an analyst under every industry sector, and when we do need additional services, then we will target those additional services where required. But we like small teams and the discipline that provides you in terms of your focus.
Maybe for Callum, what are the disadvantages of large fund managers in your view?
I just probably want to be a little bit careful how I answer that, because I don't want to be seen to be criticising. I'm more focused on doing the best we can for ourselves. Probably the best way to answer is, why did we set up? So we set up, we've got all focused on a particular way of doing things. So everyone's running at one target. And we're totally, focused on that. All that said, you do need a good number of people. So we've got 4 people focused on a small cap strategy. That's pretty much the same as I understand it in the various institutions. Their small cap teams are of that size. So we feel, we can be very competitive. We've won the Fund Manager of the Year a couple of times, competing against boutiques and institutions. So, we'd like to think that means we can compete. Very, very well. So, I've worked in institutions myself, obviously, a couple of them in the past. I thought they were very good organisations, and, we'd like to think we're a very, very good boutique. So that's, sort of my answer to that.
Carl, you select fund managers of all types. Your team does?
Yes.
Where does resourcing come into that, in considering the relevant sort of factors for success?
Well, I think it's really important, again, to look at what the teams are doing, and are they aligned with that? There's pros and cons to investing with boutiques. There's pros and cons with investing with institutions. Is the strategy that's being run have the appropriate infrastructure? I think Aussie Equities is the reason why Aussie Equities is a great thing to implement via managed accounts, is that it's quite infrastructure light when you compare it against, say, a fixed income strategy or hedge funds or anything, right? So and the reasons why boutiques are attractive is that you've got a high alignment between the principles of the business and what they're delivering for clients. And so you look at the incentive structures, you look at the financials, you ensure that the managers are aligned with delivering good returns and not necessarily, just focused on FUM gathering or getting bigger. And so you can make that assessment, and I think the really important thing is to have a good history and experience with managers when you invest. And if you can't source that, acknowledge that, that might be a gap in terms of what you're looking at, because it's really important to know that what managers are saying today is what they've always said, and they've stayed aligned with their values and aligned with their approach. Yeah, they're not just sort of adapting as they're getting bigger and the dollars and incentives are getting larger, and then they can sort of say, oh, did I say capacity was here? It's actually here, or and so experience with a manager and I think good manager research is just as relevant with managed accounts that it is managed funds. And so you need to make those assessments when you're investing. You need to make sure that teams and organizations are fit for purpose and aligned, and good businesses across a range of different factors in terms of delivering for your clients. I think that's the most important thing. You can't just say boutiques are superior, institutions are superior. You've got to look at what's going on and what is the portfolio that's being managed.
Thanks, Carl. Marcus and Callum, we're just about to end the session, so if you could give some concluding thoughts on the advantages of running an Australian equities portfolio in managed accounts as a boutique. Marcus?
So I think the key advantage is just around the focus of the companies that screen in our universe, and that's quality, and the ability of the team to be able to get out and do primary research of company visits and industry visits, and have that flexibility to be able to do that in a focused approach is our key advantage.
Okay. Callum?
Well, I do feel as a boutique, we run a non-benchmark unaware strategy where we're trying to find the best possible business franchises. So the portfolio that comes out, doesn't look like any index. I think it is in many ways potentially a little bit easier to do something like that in a boutique, because everyone in the whole company knows exactly what you're doing, and you're sort of fully aligned in producing that outcome. And I think if you're benchmark unaware, it does help you deliver excess returns over time. So I do feel as a boutique, it's not say you can't do it at the institution, but I think in some ways it's easier to do that when you've got a smaller focused group of people. And with respect to managed accounts, I think just and Kyle has talked about this too, as has Marcus. There are some nuances with managed accounts you need to get across, and you need to be focused on them, and you can't just get lost in the system. And I feel as a boutique, we're well credentialed to do that and to focus on it. So it's sort of a couple of brief comments I've made.
Okay, thanks, Callum, Marcus, Kyle, for your contributions. I'll just hand back to Toby now to wrap up the session.
Look, thank you very much. It's been great for me to listen to the panel discussion that we've had today. Each of the panelists who's taken part has been a finalist in the IMAP Managed Account Awards in Australian Equities, and in Blackmore's case, a winner the year before last. So thank you very much. So one brief reminder that next Wednesday we'll be looking at the issues of running international equities from Australia as a smaller manager, and then on Friday we're drawing together the threads of portfolio management and looking in particular with a focus on alternatives. So we look forward to you joining us on Wednesday and Friday. To Marcus, to Kyle, and to Callum, thank you very much for your input today. Nigel, thanks for your role in leading today's discussion, and we'll look forward to talking with you all again on Wednesday and Friday. Thanks very much.
Thanks, Toby. Thanks.